Now, basics of corporation tax. In this chapter, all the basics of this very tax is being explored. Now, let's take a look at a few things which are explored in this particular chapter. One is with regards to the accounting period, then about the residency of companies, then about the taxable total profits format, and each elements and how is it different from individuals, and we'll see more about them. Then about how to calculate corporation tax liability. Now, coming to the very first point, now, income tax liability is calculated based on taxable income. Similarly, corporation tax is calculated based on taxable total profits. Keep that in mind. It's calculated based on taxable total profits. And what are the difference between a period of account and an accounting period? A period of account is the period for which a company prepares its books. Like it can be 16 months, 8 months. It's their wish. Accounting period is a proper 12-month period. It can be 12 months or shorter than that. Right? So you can just take it this. Income tax liability based on taxable income, corporation tax liability based on taxable total profits. Income tax liability is paid every tax year. Corporation tax is paid every accounting period. So take a look at that. Then when does an accounting period start? This is quite important. It starts when the company starts a trade. That's a very important point. Starts a trade, not like when the company is incorporated, but when it starts a trade or when the previous accounting period ends. And when does an accounting period end? 12 months after the beginning of the accounting period or the end of a company's period of account or date the company begins or ceases to trade. Now, when it comes to long period of accounts, like let's say a company has 16 months or 15 months, what happens? How do you split that? First 12 months and then the remaining 3 months. So first 12 months will be the first accounting period. The next 3 months will be the coming accounting period, right? Now, you can see one example over there. I hope you remember that. Now, with regards to tax residence of a company, I hope you remember there are two factors when it comes to tax residence of a company. First, company incorporated in the UK. By default, it is a UK resident company. Now, companies incorporated overseas, but if it's central management control is in the UK, it is actually a non-UK resident company. It is still a UK resident company. Right? That is the central management control is not in the UK, but they are centrally managed in the UK. So right now will be a good time to take a look at the chart, which I had given you in your notes. Now, coming to the format of taxable total profits, take a look at this format. Yeah, a few things you need to remember. What is the difference between total profits and taxable total profits? Corporation tax is based on total profits, taxable total profits is based on taxable total profits. Now, often students confuse trading profits with total profits. Remember, trading profits is what the business, the company generates from its business. Total profits is the total of all the income it generates, not just what it gets out of this business, interest income, chargeable gain, and everything together. So don't confuse both of these. Now let's look at each one of these details one by one. And when it comes to trading profits, it's similar to your TATP, which you studied in the individuals area. What are some major differences? Private use adjustments. Private use adjustment is actually there in the case of individuals, but is not there for companies, which means when you do TATP, you don't have to add back the private use. Also, when you do capital loss, there is no such thing for companies. There is no such thing as assets for private use. Keep that in mind. Then a few more other things. Dividends payable by a company are not allowable as a trading expense, right? And when there is a short accounting period, remember to do time apportioning for the AIA, WDA, but not for the FYA, right? For the long accounting period, you already know what to do. Now, when it comes to property income, so we're looking at these items one by one, each of these items one by one. So we've discussed trading profits. What about property business profits? Now, you already studied property business profits in individuals. So these are companies. The difference is it is accruals basis. By default, it's the accruals basis, right? And in the individuals area, use of finance costs with related to a property, you can't reduce it. But that's not the case with regards to companies. There are separate rules for that. We're going to look into that. No renter room relief. Then if a company makes a property loss on its properties, it must be offset against total profits before deduction of QCD of the current period. Any excess is carried forward against total profits. A lot of information there. The only thing you need to keep in mind is accruals is followed, right? And when it comes to interest payable on loan, then you just have to think about the rules which you're going to study now. Interest income. Okay, now interest income, before I show you the chart, let me show you something else. Okay, keeping it as simple. Now, when it comes to interest income, yeah, when it comes to interest, so interest, let's say in the case of interest, there is interest, so interest payable and there is interest receivable. Yes, there is interest receivable, right? Interest receivable. Now, interest payable can again be of two types, for trade purpose and for non-trade purpose. Whereas for interest receivable in your tax exam, always you can assume it is for non-trade purpose. Okay, now let's see the treatment of each of these. We can apply our logic. Okay, now trade related interest payable. Will the taxman allow you to reduce? Yes. So we can write there deductible. We are supposed to deduct from TATP. What about a non-trade related purpose, non-trade related interest payable? Will the taxman allows you to reduce some trading profit? No. Therefore, where are we supposed to deduct it from? Deduct from interest income. Okay, interest income. Now, when it comes to interest receivable non-trade purpose and non-trade related income, will the taxman allow us to show that in the TATP? No. Therefore, we show it under interest income. So, show under interest income. This is the actual treatment with regard to each of these. You don't have to mug it up. Now, I'll ask you one question. Let's say, okay, interest income, interest payable for non-trade purpose, they had reduced it in the SOPL. So, what all things do you think we should do? We need to add back what was reduced in the SOPL and reduce it instead from interest income, because the actual treatment we are supposed to reduce it from interest income, not from your SOPL, right? So these are some things to keep in mind. Okay, and some things which I want you to see is when it comes to interest income, see interest income, both of these, interest income, non-trade related, interest payable, interest receivable comes under interest income. These are a few things to keep in mind. Now, coming back to what we are looking at, interest income is done, right? And be very careful in the question. Are they giving us the accruals figure or the cash figure? If it's the accruals figure, like, sometimes it confuse you. They give you the SOPL and they also say opening interest payable was this much, closing interest receivable was this much. You just have to ignore that. You can right away take the amount from the SOPL. All right. But what if they give you the cash figure? What if they give you the cash figure? What if they give you the cash figure? Then let's take a look at what we will do if they give you the cash figure. Let's say in the case of interest paid, they give you the cash figure only in the question. When you're making the TATP, okay, when you're making the interest income, let's say interest income, you want the interest payable amount. So it is cash paid, okay, plus closing balance minus opening balance. Okay, closing balance minus opening balance plus interest paid. Now let's say it is interest received. They gave you the cash figure and not the accruals figures. How do you find the accruals figure in the case of interest received? That is interest received plus opening balance minus closing balance minus opening balance. Keep this in mind. All right. And you know what to do with QCD. And when it comes to dividends received from UK and overseas companies and never included as part of TTP. Yeah, taxable total profits. UK and overseas companies. Now, you know what to do with regards to long period of accounts. Now, corporation tax liability, taxable total profits into 19% gives us the corporation tax liability. All right.